Thank you, Barbara, and good afternoon. I want to take the opportunity now to talk you through our commercial P&C segment and through the deployment of our global businesses and our global platforms, we're going to both expand our margin and drive profitable growth to support the strategy that both Oliver, Giulio, and Barbara have spoken about. So if I can show you, first of all, please, the global commercial business. Overall, I think this is probably the first time you've seen it in this sort of setup, and I'd say right from the outset, it's a portfolio construct which is both balanced and one that we're very comfortable with. All of the component parts are complementary to each other, and a number of the skills are fairly intertwined. So it consists of 4 businesses. First of all, our large commercial business, which we go to market there as AGCS. Secondly, the mid-corporate business, then the credit insurance business, and finally, a modest-sized third-party reinsurance business. Collectively, it's about 20 billion of premium, which makes us one of the largest global commercial insurers, and it's about 35% of our overall P&C premium. The rest of the P&C premium being made up of our traditional retail business, our SME, Allianz Partners, and our fleet business. We believe that there are a number of factors which can help us to drive growth in this business. They're more macro factors driven by, obviously, the economic recovery, digitalization, the infrastructure renewal, and then broadly the green transition. And all of these help from a well-placed commercial insurer to drive growth through the portfolio. So what I'll do now is go through each of the 4 component parts to show you how we're going to do this. First off, for AGCS. Now, this business has gone through a ton of change in the last 2 years. We've got a whole new executive team in place, led very ably by Joe Muller, who's put in place a real clear strategy and clear direction for the business. And we've invested heavily in terms of technical excellence to improve the portfolio. Let me give you some examples. So we now have 80% of the premium underwritten and priced on contemporary, much more appropriate pricing tools. We have 1/4 of our business individually case underwritten by a price actuary. We've also exited some unprofitable business. We've exited about 700 million euros of unprofitable business. Now, that business was performing well north of 100% combined ratio, and just by taking that out, we can improve the loss ratio between 2019 and 2021 by about 3.5%. We've also been making a significant change on the expense side of the equation. We've reduced headcount over the period by 7%, but we've also been driving a much simpler, more sensible global structure and have been investing in the key areas we need to. So again, for instance, we've improved and increased the number of our professionals in the areas of pricing, portfolio management, and actuarial by 50 people over the last 2 years. Whilst we've been doing all this, rate has clearly been our friend. We've generated effective rate changes on our renewal business by about 26% in 2020 and 15% year to date this year. And both of those are obviously well north of loss cost inflation. We think going forward that the rate increase will continue into 2022, albeit on a more muted level, but again in excess of loss cost inflation. So with that, we've also been taking the opportunity to build much greater resilience into the portfolio, as Oliver mentioned, to reduce the tail risk of the business. So to give you a couple of data points here, the overall aggregate exposure of our business in AGCS over the last 2 years has reduced by 32% for a corresponding change in terms of premium by only 7% reduction. Another example would be on financial lines, where we've reduced the aggregate exposure by 33%, but actually increased the premium from that by 13%. So just think about what that can do to the overall shape of the portfolio. It's a significant improvement. We've also optimized the reinsurance. When I started on the 1st of January this year, our maximum per risk net exposure for the group for business written by AGCS was 150 million euros. In June, we took it down to 75, and as of the 1st of January next year, it'll be 50 million. So that's 1/3 net per risk across a 12-month period. Again, a very significant change in the shape of the portfolio. The business also benefits from a range of other reinsurance protections, and we've got quota shares on most of the lines of business. So we've really dampened down the volatility. So as Giulio mentioned in the third quarter earnings call, we're drawing a line under the remediation effort now, and the aim going forwards is to drive profitable growth. Now that will come in a number of different areas, but our focus for the moment will be on the captive and multinational business, which is clearly in demand given the market situation. It'll be on property soft occupancy, where we will not significantly increase our cat exposure. And it'll be on some specific areas around the specialty business and around financial lines. And the last piece I'll give you on AGCS before I move on to the numbers is just from an NPS perspective. Our customers really trust what we're doing, and the scores have been super positive for us in terms of both our claim skills and our risk engineering, which are clearly super valuable to our customers. So in terms of output, on the next slide, please, you can see the journey we've been on from over the last couple of years. We believe the actions we've been taking will allow us to deliver a 98 combined ratio this year and move forward to 95 over the next 3 years. Now that 3 points of difference will come from both loss ratio, 2%, and 1% from the expense ratio. So we're driving both margin and positive impact in terms of the loss ratio. Now the key thing here is really about volatility. So we think the actions we've taken around pricing, reinsurance, terms and conditions and the like will basically drive down that corridor of volatility to plus or minus 3% through the cycle, which is a significant improvement on what it was before. Okay, let's move on please now to the mid-core business. First of all, what is it? It's a business which sits between the SME sector and the large core business. And by its very nature, the SME is much more standardized and automated, and the large core business and the mid-core business is more individually underwritten, needs much more human intervention, and is much more bespoke in nature. So the mid-core business is about 7 billion euros of premium, spread across 40 different operating entities. 2/3 of that's in our European heartland. And then from a line of business perspective, the largest line is property, but we've also got a really healthy spread of the other lines of business, which comes at a much higher margin for us. Now, those 40 OEs are not all made equal. The largest, as you'd expect, is right here in Germany, which is 1.7 billion euros of premium. And the smallest is only 4 million of premium. So you've got to have an operating model which supports both of those, but also brings the value of the global corporation to bear. So we've changed the operating model on the 1st of July this year, and we've created an organization called Global Commercial. On the next slide, please. And what this does basically is allow us to have a consistent global strategy with a consistent risk appetite across the board, and enables us then to basically drive through the use of global tools around pricing, portfolio management, and risk assessment. So we've got the benefit of scale brought right to the local entity very, very quickly. We're also in the process of pooling all of our data globally. So by the end of next year, we'll have the majority of our core lines of business on one global data platform, which will enable us to make much better data-led insights into our portfolio and drive a better outcome for the shareholders longer term. And then also, just in terms of that fact that not all OEs are made equal, we're driving a hub and spoke model for some of the more emerging and developing markets so that, again, we can bring those capabilities to bear super quickly. Now, this business at the moment runs at a 97 combined ratio, and our aim going forwards, on the next slide, please, is to drive a 4-point improvement in this to bring that down to a 93 combined ratio. We'll do that in 3 areas. One is profitability, one is growth, and one is productivity or margin expansion. The profitability will largely come from the deployment of these cloud-based pricing, portfolio management, and risk assessment tools, but we'll also deprioritize property growth and emphasize more growth in the other higher margin lines of business, which are clearly in demand by our customers. The growth will come from our European heartland, but will also come through a lot of the hubs around the world. And then from a product capability or product perspective, we've been told by our customers that very much in demand are industry packages, mini multinationals, the financial lines of business, and renewable energy, all of which we're eminently well placed to provide. And finally, to talk to the point that Barbara mentioned before about global platforms, We believe strongly that the lower part of the mid-core business we should turn much more into a flow business where human intervention is only where required and where it can add value. So to that end, we're in the process of developing a harmonized front-end platform that will give us automated connectivity to our distribution partners. We'll pull together all of those tools I mentioned before, which will really increase the speed to market and the efficacy of our capability to our customers and to our distribution partners. So we think overall that actually we're really well placed to take advantage of this mid-market opportunity, given a few factors. First of all, our global scale, I've mentioned at 7 billion euros already. Secondly, the brand that Oliver referenced earlier. Third, our distribution reach. And then fourth, a lot of the global IT platforms. So collectively, we believe this will drive that 4-point margin improvement. Moving on now to Euler Hermes, our third part of the segment. Now, this is a really cool global business. Number one in the highly profitable trade credit insurance market, 25% market share, and the best NPS in the industry. It has super high barriers to entry for new entrants, and I think our own competitive moat is built around three core things. It's built around credit assessment, credit underwriting, and then the real secret sauce actually is in the claims and collection capability. So in terms of credit assessment, over the years we've built up a database now that exists so we have credit data on 80 million companies globally. And through the deployment of a range of artificial intelligence tools, which we've developed over the last 5 or 6 years, we can make automated buyer decisions on 80,000 customers per day. 80,000 customers per day, no one touches that business at all. Okay, it's a remarkable setup. This is underpinned by 600 credit analysts, which give a super strong service to our customers. Then, as I say, the real quality at the end of the process is our claims and collections capability. And over the 5 years pre-COVID, this team, and they're spread all around the world, were able to bring down the initial amount of a claim by 40% through their actions, which obviously gives a great benefit to the client and also great for us in terms of loss ratio. So this is a data-driven, tech-enabled business led by market and credit experts, and one which we're rightfully very proud of. So in terms of output, this business has, over the last 20 years, run at an average combined ratio of 83%. And for the 4 years since we've owned the last part of the minority stake, it's generated a cumulative operating profit of 1.4 billion euros. As you can see here, there's been numerous shocks and challenges economically. And what's great about this business is that they can really flex their underwriting approach, risk appetite, and products super quickly to protect the business. The slightly elevated number there in 2020 is as a result of the state support schemes, which were only in Europe. All of those were off now as of the 30th of June, and the business has returned to a much more normalized run rate of profitability. Okay, so to the fourth and, beg your pardon, growth. Yeah, we should grow this business as well, obviously. So the profitable growth, given the track record of history we've got, the growth we want from this business is 6% going forward. So we want to grow this business at a CAGR of 6%. That's double what it's been historically. 2/3 of that growth will come from our traditional trade credit business, but with a particular emphasis on the US, where the market has been underpenetrated for a good period of time. The other third of the growth will come from some specialty trade credit business, plus also a focus on surety, given some of the unique credit skills we've got in the business already. In order to bring the business in line with the group across the board, we will be rebranding this under the Allianz brand going forwards into the first quarter of 2022. Beg your pardon. And the final piece on Euler Hermes is that, as I mentioned before, a lot of these businesses are fairly intertwined. So what we've done here is to use those credit and data capabilities to enhance our business elsewhere. For instance, we use the credit skills from Euler Hermes now to help us underwrite D&O in AGCS. Okay, the final piece now we'll move to is the reinsurance, which is an internal reinsurance vehicle helping us to manage both capital and risk across the organisation. It's also the entity which purchases our Nat Cat retro program. But the core business, as I say, is about managing capital and risk across the group. It does this via writing quota share business of all of our operating entities, and over the period shown here, it's generated over 7 billion euros in cash benefit for the organisation. It does this by taking advantage of the diversification benefits of the group, and that also enables us to write third-party reinsurance, again because of the diversification benefit. Now, we write a modest portfolio. It's about 1 billion euros, give or take, but it runs at a 94 combined, a 15% ROE, and is very low in terms of volatility. So never in this period has it been above 100%, and most of the business is low volatile structured reinsurance. So you should not think we're going to grow this business significantly going forwards. We literally will flex it up and down with the market, but we'll be very focused in terms of value around both that combined ratio and the ROE. So let me just briefly touch on the Nat Cat program. On the right-hand side of the slide here, you can see the performance of the program over the past decade. It's been super resilient through some very difficult cat years. So overall, it runs at a cost to us of 1.9% of net premium earned. And on the left-hand side, you can see the actual setup for the current program. So this shows you the 2021 program. It's been, as I say, resilient in a pretty difficult cat year. And you can expect us to continue with a similar program going forwards. We've just actually tested it in the market, but given the resilience and given the performance over a long period of time, we'll stick with this program. But you should expect us to increase the aggregate protection going forwards. And we're in the market now to do that from 1/1. This Nat Cat structure, this retro structure, is very conservative compared to our peers on a number of levels, not least of which the percentage of operating profit exposed or the percentage of group equity at risk as a result of this. So it's a super strong program. So before I hand across to Andreas, let me try to pull this together in terms of the ambition for commercial going forwards. I firmly believe that the actions we're taking on AGCS, the work we're doing on the mid-core business, and the profitable growth from Euler Hermes will enable us to generate an additional 500 million of operating profit by 2024. This will come by taking the combined ratio of AGCS from 98 down to 95, mid-core from 97 to 93, and most of the profit growth will come from those areas, but also strong growth and profit from Euler Hermes as well. So that's really the story for the commercial business, and with that, I'll hand across to my good friend and colleague, Andreas Wimmer, for the life sector. Thank you.